Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Let's get talking about WeWork India Management Limited. Quarter 3 was one of the strongest for the company. This time around, on an adjusted basis, the company saw a revenue growth of 10% on a sequential basis. Adjusted EBITDA for Ind AS was up 14%, and adjusted profits came in at 52 crore rupees. Now, do remember, for flex working spaces, they do have to adjust for the Ind AS adjustments, and that's why the reported and the adjusted numbers look quite different. But to understand more about the internals, we have with us Karan Virwani, Managing Director and CEO at WeWork India, joining in now. Karan, good afternoon. Thank you so much for joining in. It's been a strong quarter, second consecutive quarter of profits, even on an adjusted levels. Give us a sense of how occupancies have been in Q4. Split it for us in terms of mature centers and new centers, and what was the seat addition?
Thank you so much for having me, and it's good everyone's starting to understand these adjustments and the fact that we have to make it. Occupancies rose steadily from the last quarter, to about portfolio level occupancies closer to about 84%. Mature buildings have now crossed the 85% marks. They're actually closer to about 87% for this quarter, so that's a great sign. With growth centers also now crossing the 66% mark. So overall occupancies have gone up significantly, and we sort of expect that to continue to strengthen, just looking at the demand that we're seeing in the business.
And what was the seat addition this quarter?
Sorry, I didn't catch that.
The seat addition this quarter. Q2 was the highest ever. Have you crossed that mark as well?
Yeah, we have. So we did close to about 10,000 desks worth of sale in the last quarter. So YTD velocity is up nearly 40% from last year in terms of total desks sold. We also notably opened a large amount of desks. So today we have operational about 121,000 seats, which are open and operational, about 8.2 million square foot. And by the end of this year, end of this financial year, we'll get closer to about 130,000 seats operational.
Okay, so that was actually my next question, Karan. Hi, welcome to the show. This is Ekta. Your seat addition in Q3 is what you spoke about, but what are you closing FY26 with, and what is the trend that you might be seeing for FY27?
So, like I said, we'll close closer to the 130,000 seat mark by the end of this financial year. And the way next year's looking, it will be roughly in the range of 25 to 30,000 seat additions for next year as well. A lot of them driven by some really strong back-to-back deals that we've won over the last few quarters, as well as our expansion of WeWork branded spaces that we continue to see a lot of demand for.
Okay, Karan.
So capacity addition has been roughly in the 20-ish% range, and it will continue to accelerate at that pace even for next year.
Okay, we'll continue at that pace for the next year as well. But you have plans to take your total capacity to somewhere around 11.4 million square feet, right, over a period of time. What is the time period? By when do we expect that? And what is the capex that you may require for this as well?
Yeah. So like I said, 11.4 roughly amounts to about 177,000 seats. So we'll be at about 160 by the end of next financial year. And we already have identified that roughly like 20,000 for the following financial year, which is FY28. So great visibility on the portfolio. From now till then, it's almost a 40% capacity growth, that we'll see coming in the next two financial years. And our capex spend is roughly the same. It will be roughly in the range of 300 to 400 crores for spaces, and then some other additional capex for refurbishments and things like that we do on the existing portfolio.
Karan, when you talk about capex, 300 to 400 crore rupees, what will you be funding it with? The free cash flow completely, or will you use that free cash flow to pay off your debt? What are the financing plans from here on?
Yeah, I think that's a great question. So if you see our free cash from operations just in this quarter itself was over 200 crores, which has grown almost 150% since last quarter itself. So the business is generating enough cash to sustain the entire capex requirement that we have. Our debt levels, our net debt also dropped from roughly about 310 crores to about 110 crores in the last quarter. And we expect the net debt levels to get to zero zero basically by the end of this financial year. For next year, we will be funding majority of the spend of the capex through our internal accruals, but we have recently got a credit rating upgrade to grade A. We've seen our cost of debt actually drop significantly, and like I mentioned, some of the deals for next year are large contracts that we've won for large enterprises. So those deals, we will raise some cheap financing to fund the capex and balance the liquidity as well as the capex spend. By the end of the next financial year, our aim is to continue to keep the net debt zero level, even as we maybe raise some small debt for some of this capex financing.
Okay, all right, fair enough. Just wanted to get more of an idea with regards to what you are doing in the Lux property space, whether or not you have those kind of properties which are available at this point in time, and what the rental yield would be like on those as compared to your other properties, and hence how would that be margin accretive on a larger basis?
So as you know, we are, really a mid to premium player in the market. Pretty much all of our spaces are in grade A assets and grade A spaces. So nothing majorly changing there. We in fact have a few assets opening in the next few months in super prime locations like AeroCity, that are slightly more expensive. And our pricing compared to the rest of the competitors are almost double already. And our revenue to rent ratio is holding at that 2.8x, which is something that we've been industry leading in. And we kind of think that that continues even as we continue to grow. There is a clear premiumization and the demand that companies, are asking for and the type of spaces that they want. And so we feel like we're in a good place to cater to that demand. A lot of other operators are trying to, do the same, but there's a clear difference in the product, I would say.
Right. Karan, with all these properties coming in as well, what is the margins? Because you've already moved up from somewhere around 14% to 21%. What is the steady margin that we can expect now? Is this 21% new normal, or can we expect higher margins? What is it?
The margin is a lever, or growth and margin go sort of hand in hand. And if you see, we've been growing at a decent pace. In fact, next year we're looking at slightly higher growth, but we want to maintain this 21% margin even with the growth coming in. You see the mature buildings itself have occupancies have grown close to about 87%. Our center level margins are roughly about 28%. So that's the real potential that the business has if tomorrow we stabilized on growth and we weren't growing. But expect a similar range of 20 to 21% even as we continue to grow and accelerate the growth in the business.
Last question before we let you go. How often do you take price revisions? Is there anything which is coming in FY26, FY27, which will be a major boost to margins and growth?
So we have contractual escalations built in all of our agreements of roughly about 6 to 7%. We see pricing roughly has sort of increased in that kind of CAGR year over year also. So you can expect that from already locked in contracts. And as we continue to open new locations, it does depend on where these locations are opening, because that has an impact on the average price that we realize. In some lower price markets in that quarter, it might slightly bring it down, and if we open higher price markets, it will take it up. But we try to keep to that 2.8 2.9 revenue to rent ratio so that the spread and the margin in the business continues to stay strong. You'll see our ROCE numbers have improved to 32.6%. This is higher than any other real estate adjacent asset class. If you look at hospitality, hotels, etc., we are far above that when it comes to ROCE margins, which is a great reflection of how that pricing and cost and capex spend are sort of playing out.
Right, Karan. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the second consecutive quarter of profits that WeWork has reported on an adjusted basis. The stock currently down around 1%. We'll take a short break. But up next in our What's Trending segment, we will focus on the big news of the India-EU Free Trade Agreement. That discussion coming up next. Stay tuned.